Tom, let's talk about those various segments of the business. The revenue from the Client Solutions Group, this is the PCs to the commercial clients, really good. The revenue from the Infrastructure Solutions Group, where the servers are, not so great. Can you talk to me about the dynamic that underpins the trends in each segment, those two specifically, if you can, Tom?
I'd be happy to, and good morning. So as we look at the market and look at the business, we do believe that we're well positioned given our large and diverse solution set that we have. And while we do believe there is a technology spending cycle going on, there's obviously elements that are softer than others. And as we looked at the quarter and as we see the quarterly results, very pleased with our client business, up 6% year over year. Very strong profitability, great receptivity for our commercial client. The Win 10 refresh continues to be strong, and the innovation that the team is showing in our product line is coming through. You parallel that to what we saw in the infrastructure business, and coming off a very strong last fiscal year, we have seen a little bit of softness in the server space, as we've talked about, and we talked about it last night on the call. So I think we're navigating through that. Pleased with storage at 1% demand growth. That's an area of opportunity for us, but overall, the ability to balance the various growth levers that we have within the business, I think, is quite appropriate and quite strong, and we're pleased with the overall quarter.
And the equity market seems to be pleased with the overall quarter, more than pleased at the moment, Tom. I want to talk to you about that tech spending cycle, though. Just how divorced are elements of the tech spending cycle from some of the cyclical concerns in places like Europe, Asia, China specifically?
Well, clearly the spending cycle is not immune to some of the macro dynamics that we see in the environment today. But if you step back and think about it, businesses are investing in technology. There is a digital transformation happening. Perhaps that's an overused term, but businesses are using technology to build and differentiate their business model. And so there is a long-term technology trend cycle that we think is positive, and IDC would say it's 2 times GDP over the next few years. And so as we look around the globe, we're navigating. We saw nice strength in North America. We've talked about the fact that China's a little bit softer given the dynamics and some of the economic dynamics going on over there. And, we have seen Europe has been strong, but, has slowed a little bit for us as whether there's the GDP dynamic over there or whether it's Brexit. But overall, we're pleased with our execution. Our coverage, the fact that we're in 180 countries around the globe allows us to sort of pull the growth levers where we see the opportunity.
Tom, a lot of people identified the difference between the larger companies and what they're spending on IT right now and the tech spend of the smaller companies. Weakness at the top, strength at the bottom. What explains that, Tom?
Well, look, I think as you look around the globe and you see the large enterprises, we talked about it last night on our call, that there is some softness there in terms of the spend cycle. Some of the cycles are elongating. As they think through, what's the uncertainty in the environment, and I think uncertainty is a key inhibitor, if you will, to business confidence, and so clearing up some of these macro uncertainties would be helpful. You contrast that with, we saw really strong growth in our small business and medium business areas of our business, and pleased with that performance. And they tend to be more sort of perhaps U.S.-centric or single country specific. So when you balance the macro dynamics with some of the growth levers, overall, I think a reasonably strong quarter for us. So pleased.
And an emphasis on cutting down the debt pile once again. You repaid, I think, about $2 billion of gross debt in the most recent quarter. And Tom, I'm trying to understand the mix between paring down the debt load, deleveraging, and the mix of, say, the capital returns program, M&A perhaps as well. Where's the emphasis? Is it more on the former than the latter?
Well, Jonathan, as we've talked about in the past, we did put debt on the balance sheet when we did the EMC merger a few years ago. We've been steadily paying down that debt. Our capital allocation policy is very focused. Roughly 2/3 of our capital is focused on debt repayment. We've paid down $17 billion since the EMC transaction. We've paid down $2.4 billion year to date. Having said that, we are still investing in the business. We're still investing in R&D. $2.5 billion. Roughly $4.5 billion of R&D spend a year, and we're investing in Dell Technologies Capital, our venture fund that is focused on next generation technology. We continue to look at M&A. You've seen VMware do some M&A this quarter. So, all in all, I think we're doing a reasonable job of balancing the needs of capital versus, quite frankly, being focused on taking debt off the balance sheet and focused on getting back to investment grade over the next 18 to 24 months.